Welcome back, traders and investors. We have Stephen Burns on the line. He's a trader, author, and blogger at newtraderu.com. Stephen, how you doing on this Merger Monday?
Doing great, doing great.
Yeah, you participating in any of these mergers? Did you have any lottery options on any of these things, or hopefully you're not on the other side of them?
No, I'm not on the side of those, luckily.
Okay.
But
We got
right
lots
now,
of.
right now, all I have right now. I'm long gold, and I've got a bearish credit spread on the unbeatable SPY. So those are
You're
the only
long.
two positions I have open.
You're long gold here. So are you looking for this market to eventually start to crater because this market just continues to drive higher, and gold's kind of obviously been weak ever since this market just has decided that it's never going to go down again. Are you looking for this market to turn around with this gold position?
Yeah, it's a swing trade off the lows.
You're talking off
It's probably going to be short term.
that 1240 level. Is that what you were identifying? Because I remember it just made multiple lows between 1240 and 1242. Is that the support level you're referring to?
Yeah, I'm playing the ETF of gold around the 120 mark. The bounce is what I got into.
The GLD.
Okay, got the
Yeah,
GL.
GLD.
And what are you looking for? You take back some of this move from 125. What are you looking for as a target?
Yeah, I'm looking for a really nice short covering move up to hopefully 122 on the GLD.
Okay, and then you're cutting bait if it takes out those recent lows, correct?
Yes, absolutely.
Okay, so you want to talk about the importance of managing the risk of ruin in trading both financially and psychologically. So that's something we could talk about all day, but we'd love to hear your points on this and just walk our traders and investors through your approach.
Yeah, I think the 90% of the new traders do not make it. I think a primary cause of the new traders not making it is they're trading too big, too much, and too fast. I think they blow themselves up. And while, in trading literature, it's talked about the risk of ruin a lot, where you have a 50% drawdown in your account. If you're risking 10%, you have 5 losing trades in a row, and you're down 50% in your trading account. It takes a 100% return to get back to even. And for me, mathematically, you're virtually ruined after you've had a 50% drawdown. I don't know how many people have 100% returns without taking on even more risk. But another aspect of the risk of ruin that's it's very little talked about is the risk of emotional and mental ruin. If you're a new trader and you're trading, you might even have a winning streak, and suddenly you have a streak of losers because the market dynamics change from what you're doing, and you find yourself down 50%. Not only do you have to have a 100% return to come back, but you're probably emotionally not ready to trade anymore. You're probably emotionally ruined where you've lost confidence and faith in yourself as a trader, and very well if trading profitably is even possible for you. So I think traders really have to manage their risk and be careful on the position sizes when they first start so they don't both ruin themselves financially by having an unbearable mountain to climb back up to get back to even, or even emotionally and mentally where they just can't do it anymore. They lose faith or confidence in themselves.
And that can lead us into your next point too, is when new traders start to get down a lot of money, they start to take on excessive risk trying to get the money back. And that just leads to more problems. So all of a sudden you're going from, maybe you're trading with a certain strategy. Now you're almost gambling like at, the casino mentality where I got to get the money back. I got to get the money back. So then you start taking on the excessive risk and it can really ruin your account, right?
Yeah, a lot of the new traders, the reason so many fail to do the opposite. As you're in a losing streak because the market environment's changed, you should start trading smaller and smaller, not bigger and bigger. And when you're down, it's time to reevaluate everything you're doing and look at your signals, look at your position sizing, educate yourself, and stop and start over smaller. Not like you said, they do the opposite. They start going big. Oh, I can make it all back in this one trade, and that's what takes a lot of people down to zero. They approach the markets as gamblers, and trading should be approached like it's a business, not like you're going to an auction or a flea market to do business, not like you're going to a casino and you're the gambler throwing the dice with the odds against you.
And did you learn this firsthand, or were you disciplined enough when you started trading that you avoid this? Because a lot of times, we like to talk to traders, and they're always willing to talk about like their best trades and not so apt to talk about the worst trades. Did you actually have to feel that gut-wrenching feeling of losing money, breaking the rules before you became more disciplined, or were you able to avoid the learning curve?
I think I had some natural personality traits that helped me, but like most successful traders, I had to learn everything the hard way at least once. I had to go through the 50% drawdown. I think what really hurt me more than anything was the winning streak. When I first started in the 90s, I had just a ridiculous winning streak and really never learned how to trade because it just was too easy with all the crazy tech bull market, and
Yep.
you just go long tech, and it was just too easy. And then I had to learn the hard way with a 50% drawdown after 2000 to really make me educate myself and get to where I knew I'd get my money back and I wouldn't give it up the second time around.
You know what? I can relate to that too, actually. I have a similar experience because I started trading retail in the mid 90s. And back then, it just seems like anything you bought, any tech stock you bought, I'd buy Amazon at 100 and literally the next day it's at 140, or Sky Mall, or all these tech, stocks. And, here you thought you were a hero. Like I was a young university punk and I'm like, I'm awesome at the stock market game. I can come in, I buy anything and it goes up. And then I started professionally at Bright Trading. And I remember my first week I made money just by luck. And the second week I had a losing streak of 17 trades in a row I lost on. I was like, what's happened to me? I'm not used to this losing, So I had to learn it all over again there. So it's funny. So, and it sounds like you had a similar experience there, like obviously in the tech bubble, you could do no wrong.
Yeah, it's funny how so many new traders too, they have a certain methodology they're going about, whether they like to short in 2008 or they like to go long in the tech. Are they trend followers or can slim investors or whatever they are, swing traders, and then they encounter them. They get lucky at first. They think their system can't lose, and then the market changes. It goes from swing market to a trend market, or it goes from a tech bubble to a tech bubble bursting, or 2009 where everything kept rallying, and then what people thought they were geniuses and found out they really didn't know what they were even doing.
Did you have to adjust? I know you had the run up in '99, and obviously you were playing the long side. A lot of people are so inclined to play the long side. Were you playing the short side at that time, or was it only after you learned the lesson the hard way that you began to adapt to the short side?
Yeah, I didn't adapt to the short side because I went through a progression where I was an investor, I was a swing trader, I was a trend. I went through a progression, and I didn't really start shorting until probably like 2005, 2006, before I ever even played the short side. I was mainly a swing trader long side. And I learned the hard way that wasn't always going to work through 2000, 2002.
So now, opportunity and pitfalls of options. You wanted to talk a little bit about your option strategies. So talk to us about options.
Yeah, I think the dangers of option traders' dangers they really face more than anything is liquidity. Anytime before anybody wants to trade an option, they better make sure there's a tight bid-ask spread. You'll find tight bid-ask spreads in the SPY, the gold ETF, Apple. Google's really good, but a lot of times option traders want to get that lottery mentality. They want to buy lottery tickets. And they don't understand the probabilities of even being successful. And then the really sad part, even if they are successful, the liquidity is so bad in some of these lottery plays that they get killed coming in and out of the trade. Maybe 10 or 15% of the trade is lost just getting in and out. If it's a $2 option, it's a 20-cent bid, they're losing 10% getting in and out of the option. So option liquidity is huge. I know a co-author of one of my books, Christopher Ebert, who's just a phenomenal option trader, and the first thing he had to look at in everything he does is liquidity. I think that's one thing they need to look at, and then the delta probabilities. If your option has a 0.10 delta, the odds are like 10%. It's even going to go into money and be worth anything in expiration. So I personally like to play high delta options and use them to replace stocks. A lot of people use options too big and end up risking too much. I like to use them to decrease risk by playing in the money and at the money options, so I have less capital tied up in a trade.
And get more bang for your buck there. You mentioned trading books here, and every trader has different people that they like to follow, different people they learn things from. Could you just share with us some of your favorite trading books, and maybe something that people should take a look at?
Yeah, I think in my time, I've read over 350 trading books now. I'm one of the top trading book reviewers on Amazon, which I didn't mean to do that. I just enjoyed doing the process of reading them and reviewing them, and end up doing really well. It's actually how I got my publishing deals was a publisher saw how many I had and thought I should post my own book if I read that many. But my favorite trading authors are Richard Wiseman, Trade Like a Casino. It's a great paradigm shift for a trader to think like being on the side of the casino, not the side of the gambler. Michael Covel, Trend Following. Of course, Jack Swager, The Market Wizard, is a great series of books. And Alexander Elder and Van Tharp are five that really, really gave me the structure to trade with when I educated myself.
And you've got some of your own trading books there too, Stephen. New Trader, Rich Trader, and then you've got a couple other ones too. Show me your options and how I made $2 million in the stock market too. That sounds like a good book as well.
Yeah, that's a Nicholas Darvas annotated version of how he made $2 million and the principles he used.
Okay.
My New Trader, Rich Trader book's done great. It was actually a bestseller, #1 bestseller for new trading books on Amazon. And my recent book, New Trader, Rich Trader 2, Good Trades, Bad Trades, it actually got to number 11 in stock investing books on the Kindle books recently. So that was really amazing how well those have done with the sea of books out there.
What do you talk about in that book?
The first one, New Trader, Rich Trader, is the 17 principles that the rich traders use that separate them from the new traders. And it's the principles that new trader does this, a rich trader does this. And the second book, New Trader, Rich Trader 2, Good Trades, Bad Trades, really goes into the dynamics of what a good trade is versus what a bad trade is. Like a good trade, has unlimited upside for profits, while a bad trade has unlimited downside for losses. And I go into 17 principles for good trades versus bad trades. So they both done really well beyond my expectations.
Can you give us a couple examples of maybe one or two of those principles just for our listeners here?
Oh, sure. A lot of them I've culled from all my personal experience and study. Let's see, New Trader, like for a New Trader, Rich Trader, actually, okay, here's new traders are greedy and have unrealistic expectations. Rich traders are realistic about their return. New traders act like gamblers. Rich traders operate like business people. For new traders, huge profits are the #1 priority. For rich traders, managing risk is #1 priority.
That's a great point right there. That's one I talk about on the show all the time. And I've been a prop trader for 16 years at Bright Trading. And that's the first thing we teach ourselves is it's not about what you're making, it's what you're losing that will keep you in the game. If you can keep those small losses small, you'll be okay. And that's what we teach as well. So I love that point.
And to close out the interview here, you have your blog, New Trader U. Could you just tell us about that a little bit, what services you provide on that, unless some people are interested in your methodology?
Yeah, my New Trader U blog, it's a blog. I have my books on there. It's right now it's just a blog. I go over every day. I go over different aspects of psychology, risk management, and trader methodology. And I give different examples every day. I have a trading tweak of the week on Friday. I have my some chart analysis on Sunday with some possible entries and exit levels. And it's just really to help the new trader. It's a real basic first level blog to try to get the new traders to survive the first year of trading.
Okay, sounds good. All right, we've had Stephen Burns, trader, author, and blogger at NewTraderU.com. He writes books, he reviews books, and he puts his money to work in the markets. Stephen, thanks a lot for coming on. We appreciate your analysis and like to have you back.
All right, thank you very much.
Thanks, Stephen. Great interview.